Hello and welcome to Macro Matters, the economics and politics podcast from Aberdeen Standard Investments. My name is Paul Diggle, and along with my co-host Stephanie Kelly, we're guiding you through the macroeconomic and policy themes which are driving global markets. And today we're talking about central bank digital currencies. So a number of central banks are thinking about the possible introduction of digital currencies, which people and businesses would hold in digital accounts with the central bank. And these have several important differences versus the digital payment methods we all know and use, and of course with physical notes and coins. And moreover, central bank digital currencies would potentially have wide-ranging implications for the role of the commercial banking sector, for the conduct of monetary policy, and for competing currencies or assets like Bitcoin. So it's an important topic for investors, and hopefully we're going to give something of a primer on the topic in this episode. But let's start with a clip from Christine Lagarde, President of the European Central Bank, talking about some of her thinking when it comes to central bank digital currencies.
We've just launched a public consultation so that consumers and Europeans can actually express their preference and tell us whether they would be happy to use a digital euro just in the way they use a euro coin or a euro banknote, knowing that it is central bank money that is available and that they can rely upon.
So that was Christine Lagarde talking about central bank digital currencies. And joining me today are David Oxley, who's a senior economist at the research firm Capital Economics. He's actually a former colleague of mine, and he has a very strong interest in and knowledge of central bank digital currencies. And we're also joined by a familiar voice on the podcast, Luke Bartholomew, our senior monetary economist at Aberdeen Standard Investments, who's also done a lot of thinking about the nature of money, monetary policy, and what digital currencies would mean. So David, why don't we start with you? The obvious opening question, what are central bank digital currencies? Don't we already have them, and we have sort of familiar forms of digital currency? What exactly are we talking about here?
Yes, so I think you're completely right. It's worth pointing out, amid all the excitement that is kind of surrounds the issue, is that they are, in one sense, nothing new. So commercial banks' reserve accounts held at the central bank currently are already purely electronic. They don't exist in physical form. So when we talk about central banks printing money as part of quantitative easing programs, of course, this is a misnomer. This is done by keystroke rather than the printing press these days. What's interesting about the recent work in the area of central bank digital currencies, or CBDCs, as a snappy acronym has been coined, is the potential to give the public access to central bank digital money, just as banks have now. And this sounds innocuous enough, but as you've mentioned, this could potentially have far-reaching consequences.
Great. Yeah. One way I like to think about it is that we have central bank money, which is notes and coins, which are liabilities of the central bank. We have digital money, which is, as you say, what almost all of us keep our currency in now. But the combination of these two things, a digital money, which is a liability of the central bank, is potentially a much newer thing.
Exactly. I think, CBDCs could potentially offer the best of both worlds. So they'd offer the 100% safety of state-backed cash, in that this is a liability of a central bank, or claim on a central bank, which cannot go bust. But all of the convenience that we enjoy by using, as you say, digital money in bank accounts. But of course, none of it's quite small, but when you put your money in a bank, you are adopting some degree of credit risk. You are providing a loan to a bank, and in extreme circumstances, as we saw during the financial crisis and people queuing up around Northern Rock branches, there are concerns about banks going under and taking your money with them. So Yeah, I think they certainly are it's quite an innocuous change, but very powerful by combining those two good elements of both.
Brilliant. And we're going to get into some of these benefits that they potentially have for consumers and implications for the banking sector shortly. But Luke, one of sort of the things to clear up when we're talking about central bank digital currencies, how they are different from or relate to cryptocurrencies, because that's the sort of digital quote currency innovation which a lot of people are increasingly familiar with. So how would you distinguish these two things, cryptocurrencies like Bitcoin and the concept of central bank digital currencies?
Thanks, Paul. So I think in the very first instance, the first thing to say is that there are genuine questions about the extent to which a lot of cryptocurrencies right now actually perform the service of being a currency, that you use them to transact in. The extreme volatility of the price of Bitcoin and other cryptocurrencies, and also other associated costs in transacting with them, means that they are pretty unviable as a medium of exchange right now. So they sort of fail in that quite fundamental task of being a currency. Sort of a lot of people therefore talk of them as being digital gold or something like that. They're much more an asset than they are currency at the moment. But putting that aside and imagining a world in which they do ultimately act more like a medium of exchange, I think the most profound difference between the two is that in our current monetary system, all money is effectively a chain of IOUs, a series of claims on other people. And money is really a liability of the central bank or private banks as we currently use it. Whereas critically, Bitcoin is not a liability on anyone. So it's sort of, some people call it debt-free money. And I suppose what this speaks to is that our current system is profoundly hierarchical or centralized, depending on sort of the way you want to visualize it, that there are some very privileged institutions, the central bank and banks, who are special, that their liability gets to count as money. And that involves deep trust between them and society. We have to trust that the central bank isn't going to debase the money supply in some way. We have to trust that banks will keep an accurate register of the various competing claims, that they won't blow up at any given moment. And really the impetus behind cryptocurrencies, in the first instance at least, was that perhaps we wanted a system that didn't rely on these special trusted parties, that we wanted a peer-to-peer trustless system, perhaps because those entities couldn't really be trusted to do that job. So the whole idea is to abolish that hierarchy. And whatever else central bank digital currencies are, they are not a way of abolishing the hierarchy of our current order. They are, in fact, in many ways, a way of reinforcing it.
Great. And we'll come back to the issue of cryptocurrencies, because this precisely the sort of competition that cryptocurrencies could represent to currency is one of the reasons why the central bank digital currency is actually of interest to central banks in the first place. Before we get into that, David, practically speaking, what would central bank digital currencies look like? So we've said they're something different from cryptocurrencies, but do we all get accounts at the Bank of England or our central bank? Do we all get debit cards from the Bank of England? How does this actually work in practice?
I think the short answer is that it's not entirely clear. I think there are a number of possible forms that they could take, and one of them is, as you've just suggested. I mean, it could be that the central bank, so the Bank of England, offers everybody current accounts, just as like we have with commercial banks right now, and they could operate in a very similar way to how we use commercial bank accounts. We could have a debit card, for example. We might have direct debits coming in to pay the mortgage and all this. The key difference between this sort of world and where we are now is that the funds held in that account would be 100% safe. So that would be a very powerful thing. Having said that, I mean, that's not the only way, only form this could take, and it appears as if central banks are kind of envisaging a sort of different a different form, where central bank digital currency is more akin to being held within a digital currency that you might hold on your smartphone or within an app, for example. And so certainly the trials we've seen in Sweden, so the central bank in Sweden, the Riksbank, is quite advanced in thinking on the subjects, and they're conducting a pilot project along these lines that has digital version of the Swedish krona being held in a mobile app that people in the trial can spend through the app or using a card, for example. So that seems to be the sort of front runner of the form what people currently have in mind. As these things could potentially morph over time and to take a more account-based form, but I think it's more likely to at least start off as a sort of payments wallet infrastructure.
And you mentioned the Riksbank there. They're clearly one of the most advanced in thinking about a central bank digital currency. And that's partly because of the decline in physical cash usage in Sweden. What are other sort of key central banks saying here? Because we've heard a little bit from the Bank of England, the ECB, even the People's Bank of China. How are they approaching the issue differently?
Well, I think there are lots of reasons why different banks are considering the subjects. I think, as you mentioned, certainly in advanced economies, a lot of the debate is being driven because physical cash usage is already very low, as you mentioned, and declining further. And so the sort of motivation here, I think, is to maintain the relevance and the effectiveness of central banks and monetary policy. So certainly taking the Riksbank for an example, at best they're worried that they could face a situation in Sweden where the payments infrastructure gets increasingly concentrated amongst a number of private firms, which could potentially leave the system open to market abuse or technical outages. And at worst, I suppose you could envisage a world where monetary policy completely loses traction altogether if the payments shift outside of the banking system, or perhaps other payment methods gain momentum and increase in popularity. These other payment methods could be provided by other central banks, potentially, if people in one country find that more useful, particularly a tech firm or a cryptocurrency. I think that it's interesting to look at the example of China in this regard, given that the burgeoning popularity of mobile payments has been driven almost entirely by two private sector firms, Alipay and WeChat Pay. So the China's efforts in this sort of central bank digital currency space are partly trying to play catch up and trying to maintain that relevance for the monetary authorities in the digital world,
And this gets us into sort of our next big question then, which is why we've talked about what these might look like, how they're distinct from other forms of digital payment. This gets us into the topic of why are central banks doing this in the first place? So one of the reasons, as you're talking about there, David, is that it simply could be good for consumers and businesses. One, because it will allow a central bank backed form of digital payment rather than private sector forms of digital payment. And you could imagine there are other forms of innovation that could spring off the back of this. I mean, you've talked a little bit in work you've done about micropayments or other forms of innovation which could come from the ability to sort of transfer money very easily. So what are these kind of consumer benefits?
Yeah, well, I think it's partly you're seeing consumers voting with their feet already. People are increasingly shunning physical cash. So, I mean, it might not be particular benefits. It's a lot more. It's just much simpler to transact with digital payments, as we're saying. Certainly in Sweden, you've had massive take up of this application called Swish, which allows people to transact money within the existing banking system, but electronically, very, very, very quickly. One of the things where COVID has changed things actually on the consumer side is that we've certainly seen evidence of people being afraid of the potential for the virus to be spread via physical cash. So again, I think that's another thing that's perhaps provided impetus to this debate over the past year. You know, you've seen physical cash usage take a further step down, and further change in consumer demand for electronic payment methods.
And the issue there is that if physical cash disappears by a consumer choice, what goes there, what disappears, is businesses and individuals having access to the central bank balance sheet, being able to hold a form of money which is ultimately backed by the central bank, rather than being a liability of the commercial bank with some of the potential credit risk that we spoke about earlier that comes with that. So providing that access to the central bank balance sheet in its modern digital form, that is in and of itself a consumer benefit.
Yes, I know exactly. I think some central banks, it depends on how you view the payment system and the ability to transact, as you say, using state-backed cash, and whether that is a public good or not. And certainly the case in Sweden, they're rapidly heading towards an equilibrium where that doesn't exist anymore. And the Riksbank's been around for 300 or 400 years, and all of a sudden you can see their role just being pushed to the side over a matter of a decade or so. So these things are changing very quickly, and the entire landscape could shift substantially very quickly.
So another one of the sort of motivations you were hinting at there, David, is the competition from the private sector to create mediums of exchange, and the importance of the central bank having effectively a monopoly on the issue of the issuance of currency in its jurisdiction, having monetary sovereignty within its jurisdiction. Why, from a monetary policy perspective, is that so important? Is it so crucial that the central bank actually doesn't get out competed from other forms of mediums of exchange?
I mean, ultimately, it comes back to the central bank being able to set the speed limit within an economy, and actually having a firm hand on monetary policy and changing monetary conditions as they see fit to, for example, keep inflation close to their target, which is what most central banks' goal is to do. So it's a case of, so it's all part of maintaining relevance and the effectiveness of the existing monetary policy channels and how they influence the amount of money in an economy at any given time.
Great. So Luke, let's get into then monetary policy transmission channels. So crucially, clearly one of the motivations is to still have monetary sovereignty, to be able to set the interest rate, to control the medium of exchange. But there are other sort of even more technical reasons why a central bank might be interested in a central bank digital currency, and that's to do with how low it could set the interest rate potentially in a world of purely digital currency. Do you want to explain those issues?
Yeah, sure. I mean, it partly depends on, as we've discussed, the form that the central bank digital currency takes. Certainly in a world in which we're talking about deposits, that households, individuals, firms have deposits at the central bank, I mean, that significantly increases the direct control that the central bank has over the monetary conditions facing these people, right? Monetary policy normally works by setting overnight rates in the banking market, and then that transmits through the rest of the economy. You sort of can almost push the banking sector aside in terms of setting monetary policy and go direct to these agents. And what's nice is that you can set interest rates negative if you want to, in a world of central bank digital currency where people have deposits there, and assuming that most cash has been abolished at this point. Because ultimately what sets the floor on interest rates is that worst case scenario, you can take out all your deposits and hold it in cash, right? Cash, one of its quintessential features is that it's non-interest bearing. You can't charge a negative interest rate on it. Now, there are costs to storing cash. You have a very large cash pile. Presumably you want some sort of security around that. Maybe the paper erodes over time. Whatever other carrying costs there are to having large wadges of cash sitting around, those mean that you can have slightly negative interest rates. That's why various central banks have been able to set interest rates negatively for the last few years, but it puts a limit on quite how far they can go. Whereas if you have a direct deposit with the central bank and no other choice to go into cash, then you can very easily, as the central bank, administer that negative rate. So that gives you, as I said in the first instance, significantly more control over monetary conditions directly and more options about the monetary conditions that you set.
Great. And David, I suppose the idea that a central bank could use this innovation to set increasingly more negative rates. I mean, that won't sound like an attractive innovation of central bank digital currency to a lot of people. And indeed, at the moment, central banks aren't really framing it in those terms, are they? They are sort of keen to say it's not a stage on the way to the abolition of physical cash.
Yes, no, I think that's exactly right. I think in the recent comments from the ECB, for example, about what potential form a digital euro could take over the coming years, they've been incredibly keen to stress that it is not intended to replace physical cash in any shape or form. I think there's a political aspect to this as well, because of course we know that even in countries where physical cash usage, such as Sweden and the UK, is increasingly rare, it is used by different parts of society. Particularly older people tend to use cash more. A lot of other more vulnerable people tend to rely on cash. So there is a political element that I think will also come into play. You know, you're not going to be a very popular central banker by coming along and saying you're advocating the demise of physical cash and the supercharging of monetary policy. I think, as you say, they're stepping much more baby steps than that.
Yeah, but we're nonetheless interested in these questions, of course, because they are theoretically possible, and it could eventually, one could imagine a world of a future shock that requires a large monetary policy response. These could become options on the table. And in that vein, Luke, another thing that a central bank digital currency could allow is the close coordination between monetary and what looks like fiscal policy, helicopter money. Could you explain how those would work in a world of central bank digital currency?
Sure. Well, I mean, again, insofar as you have an account with the central bank could decide just to credit you with some amount of money in there as part of its monetary policy, right? So as David described at the start, the way QE works is that we sort of create money by keystrokes that allow the central bank to buy bonds, and QE works that way and transmits through the economy. But instead, we could, with keystrokes, directly put money in people's central bank deposit accounts. And then, you know, sort of on top of that, you could, if you wanted, do some really, you know, sexier, more exciting stuff with it. You could put, you know, have depreciating currency, so it's worth 100 today, it's worth 99 the next day, 98 the day after that, and that's sort of meant to incentivize you to spend it as quick as possible, right? Because if you sit on this money, it evaporates in value over time. So just like having this control, this deposit at the central bank that influences all households and companies, it gives the central bank a huge range of options to pursue other policies. Now, you could argue, I mean, that's a lot of bells and whistles and changes to our monetary architecture, when it turns out, as the US is showing, is the fiscal authority can just write a check and send it out to households, right? And then the central bank can support that through accommodative monetary policy. So it's not like some of these tools aren't available now in one form or another, but perhaps they're, you know, it does require more coordination between the monetary and fiscal authority. The fiscal authority has to make that choice, whereas in this world, the central bank would be able to do it more directly. And you might think that that's a good thing in terms of managing economic conditions.
So a lot of sort of funky, interesting monetary policy options there, which might seem somewhat beyond the realms of possibility at the moment. But you know, one has to remember that 15 years ago, QE was a funky, new, unusual tool of monetary policy. So it's worth us as investors thinking ahead to these sorts of questions. So another big topic here is what it means for commercial banks. So David, people's concern is that a central bank digital currency would be disintermediating commercial banks, because at the moment we have our checking accounts with commercial banks. That's part of their role in the economy. So how would central bank digital currency change the role of commercial banks? Would it change the role of commercial banks? What are we hearing about this?
Well, I think one interesting example is coming back to China. As you say, I mean, it does have the potential to completely cut commercial banks out of the picture. But the way that China's trial of CBDC is going is actually to use the banking sector as an intermediary, so providing access to the central bank balance sheet. So, I mean, we don't need to get into the nuts and bolts of that, but I think it is interesting how China, which is perhaps one of the countries that's closest to launching one of these things, has not gone down the path that many people are talking about. I think that's quite illustrative. Similarly, they haven't gone down the sort of blockchain path that many people conflate with central bank digital currencies as well. So I think, yeah, China is clearly an example that needs to be looked at. More generally, aside from China, I think the potential impacts of CBDCs on banking sector all depends on how they are designed, what form they take, specifically whether access to them would be limited in any way. If you think of an extreme case in which access to them is completely unlimited, they would be nothing short of a financial revolution. And this is because in this world where there'll be a risk-free alternative to bank deposits, you would expect to see, over time at least, a large-scale migration of funds from the banking sector to the 100% safety of a central bank digital currency. I mean, it depends on your viewpoint on this. I think some people would point out the destabilizing potential for this. But if you take a longer run perspective, it's been put forward that this could be a big leap towards the sort of holy grail of banking reform and the separation of sort of plain vanilla aspects of the banking sector, you know, how we use banks to pay for our groceries, to get our salary paid into, and sort of riskier end of operations that banks sometimes get embroiled in. As John Kay, the economist, has described this as potentially being able to separate the utility of the banking sector, the boring aspects, with the casino aspects, which is, you know, perhaps a little bit unfair to put it. But in such a world, I mean, this could allow banks to kind of sidestep the too big to fail sort of problem that they've run into, certainly after the financial crisis. You know, you could be the case of any banking sector, a banking institution that gets into trouble, you could potentially let that fail, safe in the knowledge that you wouldn't be endangering the plain vanilla payments aspects of the sector. You know, you kind of, yeah. I mean, that's one way of looking at it. So potentially a big financial revolution. Having said that, and coming back to the ECB, it certainly is clear that many central bankers are not aiming for financial revolution. You know, that they're aiming to come in much lower below the radar than that. So the ECB have not only stressed that they do not want a digital euro to replace physical cash, they've also stressed that they do not want to in any shape or form destabilize the banking sector. And one interesting aspect they've kind of pointed to is the potential for introducing limits on the amounts of digital central bank cash that an individual might be able to own. The number that's been mooted is something like 3,000 euros. So they kind of see that as one mechanism that would enable the public to have access to central bank cash that would enable them to transact in the day-to-day transactions, but be sufficiently low so it doesn't completely undermine the banking sector. So again, I think that could be sort of an illustrative way that central bankers, at least in the next few years, might approach this.
Yeah, brilliant. And I suppose that 3,000 euro figure is sort of probably more than a lot of people would hold in physical cash, but it still gives you that access to the central bank balance sheet and, as you say, the utility of it without this destabilizing aspect. And Luke, I mean, the migration of money from the commercial banking sector to deposits at the central bank. I mean, that sounds like a bank run, right? And that's clearly a potentially very disruptive aspect of a central bank digital currency. And David's laid out some ways in which that might be avoided. But as David also says, there are ways in which you could think that a central bank digital currency increases financial stability by separating these two aspects of the commercial banking sector. I mean, are you a buyer of that argument that separating out the payment system aspect of commercial banks and the credit creation aspect of commercial banks increases financial stability? And maybe you could talk through some of the implications of actually separating out those two aspects.
Yeah, so I mean, my best guess view is that in the long run, that kind of system where the payment aspect, the checking account aspect of banks and the credit creation aspect of banks was separated would be a more safe system. But the way of getting there would be pretty bumpy and extremely destabilizing for current banks in their form. And indeed, to get to that kind of model, I think that's sort of a social debate, the kind of thing that you'd almost need like legislation and parliament to decide the profound ways in which we go about banking needs to change, rather than something you'd stumble into through technical changes around central bank money. So I think they'll be quite careful how they tread in that regard. But perhaps it's worth sort of saying a few words as to why I think it would increase stability if these two were separated. And the thought is that ultimately banks use the deposits that they get as part of the payments checking aspect of their business model to fund what they do over in their credit creation aspect. And that is the essence of banking, right? The maturity transformation that goes on there, having liabilities that are instant money-like claims and creating assets that are longer dated. And that mishmash in maturity there is profoundly destabilizing. It is ultimately why bank runs can exist, and that's why we have to have deposit insurance and various regulation. If you split the two apart, and so banks are no longer in this special position where their liabilities are money, suddenly that maturity transformation inherent risk goes away. And so effectively a bank becomes much more like an investment vehicle, right? And you know, if you invest in an investment vehicle, the value of that fluctuates and you're not guaranteed at any given time to be able to withdraw par value, the value of what you put in the way that you are with deposits, right? And once you've done that, the financial system is much, much more stable, and bank runs, at least in commercial banks, should become impossible. Now, I suppose it's worth one final thought that fundamentally the 2008 financial crisis was itself a bank run, but that was a bank run on the shadow banking system, that new forms of risk and credit creation can crop up and regulators may not be able to see or understand that. So even if we think we've solved financial risk in the banking system by separating these two, ending the standard bank model, it's more than plausible that some other new form of risk taking will crop up that regulators won't understand. So I doubt we will fully solve financial crisis through this policy.
Oh, brilliant. It's David and Luca, clearly a complicated topic, but I think one that a lot of central banks are doing a lot of thought on, that matters greatly for investors, both who care about the banking sector, but also the broader payment system. So thank you both very much for stepping us through it. Well, that's about all we have time for this week. Thank you very much for listening to Macro Matters. Remember that we now have a mailbox, macromatters@aberdeenstandard.com, and we'd love to hear from you. If you have questions, topics you'd like to see us cover, feedback for myself and Steph, please do drop us an email at macromatters@aberdeenstandard.com. Don't forget to like or subscribe on your podcast platform. Next week, Steph is back to talk about Latin American politics, which I'm sure is going to be a great episode. But until then, goodbye and good luck out there.
Please note that email is not a secure form of communication, so don't send any personal or sensitive information. This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.